Today, I'm up in the hills in Redondo Beach. It's not the greatest beach day, and that's why you see my lovely wife, Lizzie, walking next to me. Otherwise, she would probably be at the beach. She's probably not going to participate much in the video, but she's just going for a walk with me here.
Hi, guys.
Now, I want to thank DJ and Steve, because you guys are always sending me like the best stories about the economy and real estate and everything like that. And this one comes from DJ. This one is talking about how Pantheon Macroeconomics is saying how the housing market is still a long ways from bottoming out, because that's one of the big things that we're seeing nowadays, especially with the media and the headlines and all of this. I mean, I even covered this in yesterday's video, talking about, oh, housing prices have peaked beyond where they were in the summer of 2022, and that means home prices are going to continue to rise forever. And that seems to be the narrative that a lot of media agencies are pushing right now. But Pantheon is coming out and speaking against that, sort of like me, and here are the reasons why. And by the way, guys, my traditional microphone is broken. I ordered a new one, so hopefully you're going to be able to hear everything just fine in this video. So bear with me if the audio quality is not as good as it usually is. Now, Pantheon is using logic and saying that the reason why the housing market is not headed for a full recovery right now is because of affordability. Who's going to be out there buying when people can't afford to, right? And we know for a fact that people are not buying because the home sales are at abysmally low levels. Mortgage applications are at abysmally low levels. So who is actually out there buying? I mean, who's out there that they're saying is buying all this real estate? Well, I think part of the problem with that is you see all these homes go on the market and people just snap them up in a heartbeat, right? And the reason for that is because of low inventories. People who are actually out there shopping right now for homes can afford them, and they are qualified to buy these homes. And since there's such a low amount of inventory coming online, when they do come up, they snap them up. So it makes it look like things are going insane still and the housing market is still on fire, when in fact it's not, okay? But it makes the illusion that it is, because we see the listings that come up just get snapped up in such a short period of time. That makes people think, oh, well, the housing market's still on fire and the prices are still higher. Once again, that is also due to the fact that we have ultra low inventory. It's sending the wrong message, essentially. So Pantheon is basically saying the bulk of the home price drops that we're going to see have not even begun yet. And when they do come, it's going to be a pretty steep and sustained drop in prices for probably a couple of years. And that's one thing that I think is going to happen as well. But like I explained in earlier videos, we need to have a catalyst for this. There needs to be something that causes this to happen. Either it needs to be the recession, it needs to be people in some sort of situation where they're forced to sell their home because they can no longer afford to hang on to it. There needs to be something that brings on that wave of inventory. You know, you hear a lot about the Airbnb problems that we have now as well. People own a bunch of these houses and may not be turning profits anymore, and that could be with the catalyst. There's so many different things that could be the catalyst for more inventory coming, but no one really knows what, when, or where. So that's the part that's unpredictable. And I think people get frustrated because they hear these things about, you know, home prices are likely to go down, but then they only see them go up, and they just think that it's never going to happen, right? Because they're not seeing it happen yet. But if you look at cycles of the housing market, one thing we know for sure is that it will happen, and it will happen again. We just don't know when, where, or how. But there is a lot of pushback against this idea that home prices are going to go down. So much so that I think most people probably believe that they won't, because you even have big real estate firms like CoreLogic and Zillow coming out and saying that home prices have already bottomed, and they're basically using the logic that because prices have shot back up this spring and into summer back to new all-time highs in some places, that's the reason why it's all a full recovery. But remember, guys, real estate is seasonal. We are only in the middle of July right now, which is basically the end of the home selling season, and we're likely to see home prices start to go down from here on out throughout the rest of the year. And what's going to happen in the spring next year? They're going to go up again. And we know this for a fact because even during the 2008 housing market crash, even in those years when the housing market was falling the most, we still saw home prices go up in the spring and summer home selling season. And we are likely to see the same thing happen again this year and into next year. So one of the main indicators that we can also look at right now that's a little bit more immediate, that's going to basically prove this theory in the long run, that we're likely to see home prices go down, especially towards the second half of this year, but more as like a long-term trend over the next several years, is the fact of how much rent prices are going down. Now think about this. When rent prices go down, it changes the value of what that investment property is potentially worth, right? Because as a real estate investor, one thing that you want is a solid return on your investment when you're buying a investment property. And when that return starts to dwindle due to rising property taxes, rising insurance costs, it's not going to be much of an incentive to buy any type of investment property like that. You have rent in 50 of the largest US cities right now cheaper than it was 1 year ago. We also know that renting is cheaper in basically 90% of all US metros right now. So all of this points to the fact that buying a house is unaffordable for pretty much all of the everyday folk. Now here's some of the places where rent prices are down the most year over year. Las Vegas, down 6%. Riverside and San Bernardino, California, 5.9%. Phoenix, Arizona, 5.7%. Austin, Texas, 5.6%. San Francisco, 4%. Tampa and Clearwater, down 4%. Dallas, down 3.6%. Charlotte, North Carolina, down 3.5%. Sacramento, California, down 3.5%. Atlanta's down 3.1%. And Denver, Colorado is down 3%. Now, think about this. As rent prices fall, less investors are going to be interested in picking up that property as a future investment. If the current landlord and the current investor in that property is already having a hard time turning a profit, what do you think that's going to look like for the next investor who wants to get in? Okay, because that chances are the current owner bought it at a lower price and a lower interest rate than what today's investor is going to be looking at. And if they can't even turn a profit, then it's a guarantee that the next person investing in that property will not be able to turn a profit. So what happens when the current owner wants to sell that non-performing rental property? You need to drop the price, because that's the only way that a future investor will be interested in purchasing it, because that's the only way that they may potentially be able to turn a profit, especially with these interest rates. And the other thing is, guys, even besides the interest rates, okay, the sheer amount of increase in property taxes and insurance in some of these areas has gotten out of control and has become such a large expense. Sometimes it's even more than your mortgage payments. So it's just one of those things where investors have to carefully look at, can I make a profit on this property? And a lot of times these days the answer is no. And most investors are not going to be interested in buying any type of real estate that is not profitable to own. I know I certainly wouldn't buy a place that I'm going to be losing money on, at least not for an investment. If you're buying a second home, a vacation home, something like that you plan on keeping vacant for half the year or all the time, that's a different scenario. But what I'm talking about here is investors. And this kind of circles back to what I was saying in the beginning, is that this could be the next catalyst that brings home prices down. Because if current investors are losing money as rent prices continue to go down, then it's likely to drag the entire housing market down with it, especially with how many investors we saw, basically controlling this entire housing market. There was two huge players in this run-up we've had in the housing market, okay? You had ultra low interest rates, which helped out the regular everyday person as well as investors. And because prices were so low for such a long time there in the early days of the pandemic, many of these big investment firms picked up a ton of rental properties at lower prices, right? But now that the expenses for these properties are rising at the same time rents are going down, that's not good. And some of these companies might just need to make a corporate decision and say, hey, we need to unload 30% of our portfolio so we're not hemorrhaging money. And what's that going to do to the housing market, guys? Remember, the only thing that is holding this up right now is low inventory. So all we need is a couple of struggling hedge funds and a couple of struggling mom and pop landlord or Airbnb investors to put some inventory on the market, and we'll be right back to where we were pre-pandemic inventory. I mean, it's not going to take that long to get there if people are in distress. But so far, it's still a tale of two housing markets. And you know why? It's because there's other places where rent prices are still going up, right? You have lots of areas in the Midwest, like Columbus, Ohio, rent prices are up 9.3%. New York City, rent prices are up 6.8%. Pittsburgh is up 3.8%. Boston's up 3.3%. Your real estate market is going to look different than what's happening as just a national trend, okay? Because the national trend right now is rents are coming down in the 50 largest metros. But you have some pockets where things are still going up. And those areas may not get hit as hard with a real estate downturn. And that's why people get so confused. I think they hear these type of videos and they're like, oh, this guy has no idea what he's talking about. Rents are going up where I live. Home prices are more expensive than ever. And that might be true. That's going to be true for a handful of people, right? But I'm talking to the people who that's not true for, that are believing home prices will continue to go up forever, because they just won't. Just because things are going pretty well in some of these areas doesn't mean it's going to continue to stay that way, okay? Even during the last Great Recession that we had, there were pockets of the country that still thrived, at least, you know, compared to what other places were doing with their local economies and how people were struggling. So it really just depends. So really, I just want people to be prepared for the worst. And you know, what's the worst that can happen? You have money saved, you got out of debt, you waited a little bit longer to buy a house, and you know, at worst, home prices remain flat. Because in all these places where home prices actually peaked or went above last year's highs, okay, it's not going to stay there. As the fall hits and as the winter hits, those places will see prices come back down to where they were previously. If you're just a little bit patient, you might see more inventory come on the market in your area, and people that need to list will list, and you might be able to get the house at a price from last year. I think rushing to the door and just rushing into buying right now is not a good idea. But you know better than me, because you know where you live. You should be tracking your market trends, and you should be paying attention. Are rent prices going up or down where I live? What is the cost difference to buy versus rent where I live? If you can't answer those things, then you're definitely not in the position to be buying a house. Now, when it comes to commercial real estate, it's not just office buildings that are suffering, okay? In fact, Steve sent me this story about hotel REITs, the real estate investment trust that you can invest in on the stock market. You have some of these REITs struggling right now because they're looking at returning 19 different hotels to the lender. It's funny that Steve sent me this story, because I received this from him when I was on the road and staying in all these hotels. And I've been wanting to share this story with you guys, because some of these hotels are just completely awful, okay? And I'm not saying awful like the service is really bad or it was super dirty or anything like that. More of what I'm referring to here is the level of satisfaction that you would expect to get from a certain hotel. Like, for example, I stayed at the Hilton near Phoenix by the airport there. It was nothing to write home about, okay? Normally, you would think the Hilton is going to be this fantastic place. It really wasn't, guys. First of all, there was no microwave in the room. It had weak air conditioning. It worked, but you really had to keep the place totally sealed up. If you even opened the door for a few minutes, the whole place just got hot. It was an older building, so it was not really that new. And on top of this, the staff actually told us that they only had 48 rooms occupied. And I don't know how many rooms they have in this hotel, but I'd be willing to guess at least 200 rooms. It's a pretty big hotel and you only had 48 rooms occupied, short-staffed, and only two employees, right? Now, obviously, my wife Lizzie was with me in this hotel. She's been with me this entire road trip, and this was definitely not one of the nicer hotels we stayed at, right?
It was a terrible experience.
In fact, some of the smaller hotels
better.
Yeah, they were way better, you know, like breakfast
Service,
included, much better
room.
service, the style of the room, like how modern it was and not super outdated and old, all of this, right? But this Hilton, they charged $150 for the night, and they just upcharge on everything, guys. Oh, you want to eat breakfast? $30 a person, right? Oh, you want water in the room? Check this out. $3 for a bottle of water, you know, for this stupid little bottle of water, just a regular bottle. They want to charge you for every little thing. And you go to one of the regular hotels, like, what were some of the ones we went to? Like Holiday Inn Express.
Yeah, the Holiday Inn Express was a very nice.
That was pretty good, but sometimes they're not. You know, it's not like just because the brand. Yeah, the brand doesn't really mean anything. The individual hotels and how they're operated really makes a difference. Because we went to a Holiday Inn Express in Ocala, Florida, and fart, guys, terrible.
At least most of them, they do have free parking. You don't have to valet. And the one at Hilton, I think
they wanted to charge for parking.
To charge us like $10, I think.
$10 for parking.
And even though it was advertised as free parking, because that's what I was searching for, free parking, the Wi-Fi. And then he was just like, oh, we're going to give you as a complimentary or something like that.
They ended up giving us the parking for free because we weren't happy about it. And then on top of all of those things that they're trying to upcharge you, they also want to charge extra to get high-speed internet access. Otherwise, you get this crawling internet speed. And thank God for my mobile hotspot on my phone, because I didn't even use their crappy internet. It was horrible. But I'm definitely not paying them to use faster and better internet, okay? And
by the way, guys, he would not sleep until the video was uploaded for you guys the next day.
That's right.
I'm like, what are you still doing? No, I gotta wait. I have to wait. The internet sucks, but you know, at least with the hotspot, it's working. But I gotta make sure.
Yep.
So yeah, couldn't relax.
Have to get the video out for you.
All for you guys.
I wanted that to be my intro to these hotel REITs not doing so hot and having to give back some of these hotels. And it's a huge mystery of why these hotels are not performing when they're charging stupid prices for a stupid place and upcharging you and trying to upsell you on every little thing and just nickel and dime you.
And that's great.
Right. And then you can go to another hotel and pay less, $120, $130 for the night, and have everything for free. Faster internet, free parking, free breakfast, all included, right? And a nicer room on top of that.
Yep.
So big surprise that these hotels are going under right now. Now here we have actually two rental properties that are right next door to each other. This first one here is a rental building, and inside is a studio apartment for rent for $15.50 a month. And here's the interesting thing about this place. Going back to the rental history on Zillow, it actually really hasn't changed all that much since the beginning of the pandemic. They were asking $15.25 a month back then. Fast forward to today, it's still $15.50 a month. That's pretty interesting for this area of California, Redondo Beach. Price hasn't gone up practically at all in the last 3 years during this run-up. And right next door, though, we can't really say the same. And here we have a brand new rental listing listed only 8 days ago. It's a 3-bed, 3-bath townhouse for $7,500 a month. Current owner paid almost $1.3 million for it back in 2017. But they're not as lucky as some of these other people that have been hanging on to these properties forever, because their property tax bill is $16,000 a year. Still probably a little bit lower than it would be in Miami, but not by that much. Big nut to crack each month on this property. Now the name of this REIT that's going to be returning these hotels back to the lender is called Un-Affordablity Trust. These hotels are in places like Las Vegas, Atlanta, and as of June, they have been defaulting on these mortgages for these 19 hotels. And just keeping these 19 hotels would have required a pay down of $255 million just to extend the financing, and another $80 million in capital expenditures through 2025. The equity in all these hotels is already negative, so you can see why they're not willing to do this. And like I was just explaining to you before we got into this story, it's not really a big surprise that these hotels aren't doing so well, because their business model is absolute trash. They're not accommodating their customers anymore, especially some of the supposedly higher end ones. You would think you go to any Hilton hotel that it's going to be great, and it ends up being awful. So just like the residential market, whenever these hotels get released back to the lender and they're not a performing investment, just like regular investors that are investing in residential real estate right now, what do you think is going to happen to the price of these hotels in order to offload them to the next investor who's going to want to buy them? You got it. Bingo. Price is going to have to go down. So that's why I wanted to bring this story up, because it's kind of an overall trend we're seeing not only in the commercial sector, but we're seeing it in the residential sector. But it's not hitting so hard yet with residential. Right now it's affecting commercial real estate much more at this moment than it's affecting residential. But I believe it is going to bleed over into residential. It's just going to be a matter of time, especially now that we have rents that are declining. And guess what else is happening to these hotel owners, okay, and commercial real estate in general? And this might even affect residential real estate investors. With higher interest rates and falling property values, many lenders are requiring borrowers to pay down part of the debt or provide additional capital for property expenses in exchange for extending a loan that comes due. So these lenders are not willing to take the risk right now because these properties are underwater. So these current owners are going to have to step up and basically pay a lot of extra money in order to keep the whole show going with these hotels. And I'm willing to bet that the more people end up having experiences like we had at that Hilton hotel, the less people are going to be staying at these places, the more money they're going to be losing, and the more hotels you're going to see in this situation. And really, it's just kind of the same thing as, you know, good landlords and bad landlords. You have people that are really great landlords, and you know, they're so hospitable and work with you, especially when it comes to rental increases and figuring out the right rates and, you know, fixing things when they're broken. And then you have landlords that are just slumlords that don't want to do anything besides take your money and increase the rent 10-15% every year. So the one good thing is that we do still have a segment of the free market that is working right now, and the consumer still has a voice, in the sense that if you don't like a place, you don't like a hotel, you don't have to stay there, guys. I would never stay at that hotel ever again, okay? And I hope many of you that watch this don't stay at that hotel either, because it's terrible. And I'm recommending that you don't. The hotels that are doing the right thing and they're providing great service for their customers are going to stay in business, just like landlords that don't price gouge their tenants and keep them for the long term and don't have the property going vacant because of too many rental increases at a time when rents are going down. So hopefully you can kind of see how all of these things kind of work together here, and the big picture. And the big picture is that real estate values are going to be affected by the rents. It's not really much of a coincidence either when you look at some of the brands of the hotels that Ashford Trust is going to have to return to the lender. You have brands like Residence Inn, Spring Hill Suites, and the Marriott. These are all places that are supposed to be nicer hotels. This isn't Motel 6, okay? This isn't Super 8. We're not talking about those places. You don't see them on the list here. You have fancier hotels that are supposed to be doing well right now because people with money stay at these nicer places, but they're starting to find out probably that it's garbage and they don't want to go anymore. So really, after covering how this is going with commercial real estate, and now we're seeing rents start to go down in some of these major cities across the country, I think it's just a matter of time before it starts pulling all the residential housing prices down with it. The real question just remains, like, when is the recession going to hit? How bad is it going to be? And how many people are going to be left standing, and how many people are going to have money to continue buying in an environment like that, is really the answer to how long it's going to take until we really see a significant reduction in prices. Now, if you enjoyed this video, please subscribe to the channel, and if you don't want to wait for my next video, check it out on the screen right over here, and I'll see you in the next one.